Ladies and gentlemen, welcome to another episode of Boss Economics World, the channel where we dissect, decode, and debunk the antics of leaders, policymakers, and governments, and how their blunders crash the economy for the rest of us. Friends, Michael Barr, the Vice Chair for Supervision at the Federal Reserve, you might have heard of him, has decided to step down. Yes, step down. In the midst of one of the fiercest regulatory transitions in decades, just as President-elect Donald Trump takes office. Quite a surprise move, right? Or was it? Today, we're going to unpack not just Barr's departure, but how this signals a deeper economic and political rot that will have consequences for banking rules, capital markets, and of course, your wallet. So, here's an interesting idea for you: what happens when those best placed to supervise key sectors of the economy bow out? What does Barr's departure tell us about the state of financial regulation, Trump's leverage over the Federal Reserve, and even broader systemic risks to our banking system and economy? Let's begin with Barr's rationale. Barr, no doubt a seasoned and distinguished figure in financial regulation, claimed his resignation boiled down to calculus, the kind of strategic decision high-profile officials love to reference in front of the media. According to Barr, sticking around any longer under the Trump administration might shift him to the center of a storm, creating too many distractions for the institution as a whole. Now, he insists he could win any legal battle if Trump decided to oust him, but he doesn't see the fight as prudent. Does this sound familiar? It should. When a critical position in the Federal Reserve, especially one as vital as the Vice Chair for Supervision, requires stepping down to avoid distraction, the economic issue is clearly political. Barr recognized that a fight with Trump's administration, an administration that might seek to weaken regulatory constraints for big banks, is not just about legality, but about perception, control, and influence. In other words, the bigger problem here is the erosion of independence that the Federal Reserve could face under Trump. This is not just an ideological issue about Republican opposition to regulation, but a fundamental tectonic shift in how the banking sector operates. You'll notice how Barr was quietly at the helm of one of the most significant bank capital proposals, regulation that ensures big banks must hold enough capital to withstand financial shocks and downturns. This kind of stewardship is precisely what worries many in Trump's camp because it goes against deregulatory zeal. The stunning aspect of Barr's exit isn't just its timing, it's what it represents in terms of economic governance. It lays bare the deep, lingering suspicions surrounding the politicization of the Federal Reserve. Barr's regulatory approach, aimed at reining in excessive risk-taking in America's largest banks, is anathema to Trump's broader cyclical promises to deregulate and unleash economic growth at all costs. But will nobody ask the obvious question? Won't fighting to protect the independence of the institution, fighting to enforce strict oversight on banks, help financial stability in the long run? Barr's planned voluntary exit ends up shining a light on the internal contradictions of an economy driven by conflicting political aims and regulatory priorities. Now, let's zoom out a little. This resignation, essentially a quiet resignation from a war he might otherwise have won, should shake us more because of what's really at stake in terms of financial stability. Barr's most notable focus has been shoring up bank capital and liquidity reserves, making sure that American banks aren't just posting profits via excessive risk, but are also holding enough capital to weather financial storms. Yes, I said it, the storm is coming, yet policymakers seem utterly unfazed about allowing banks to undermine the economy deeper. But what happens now? Barr's leadership will be missing precisely as the global economy grows more precarious. In fact, the landmark bank capital proposal he was working on is now left in limbo, as future regulatory decisions are thrown off track. Barr's departure isn't just a loss of personnel, it signals a vacuum in leadership right at the helm of crucial financial contingency development. Here's the main problem: the bank capital rule wasn't just a pie-in-the-sky policy. It was a structural safeguard designed to prevent the types of collapses we saw in 2008. You know, when Lehman Brothers kinda detonated the global economy? The proposal forces the largest banks, those systemically important giants, to hold more reserves, a financial cushion, limiting their ability to overleverage and take on dangerous credit exposure. For ordinary people like you and me, an absence of this capital requirement is like living in a condo without fire insurance. Sure, it's fine when things are sunny, but God help you when reality hits and the market turns south. So let's step back. Think about what Barr's exit really signals. The impending shift in financial oversight could mean more reckless lending, banks pushing risky products, and, yes, another round of bubble-driven economic growth. You see, Trump's economic strategy has been clear, albeit simplistic: remove as many shackles as possible to let capital with a capital C reign freely. Unfortunately, we're no longer in an era where reckless financial growth doesn't have consequences for Main Street. This deregulation will have ripple effects far beyond the Federal Reserve walls. As professionals in finance, or those of us simply interested in keeping our homes and jobs intact, You need to ask yourself who stands to benefit from lowering capital cushions in megabanks that already control upwards of 80% of all banking assets. For everyday consumers, retirees, or small business owners, here's a harsh truth: banks slashing capital reserves is much like homeowners dipping into their emergency savings fund, not a good sign for financial stability on a systemic scale. Take the panic-triggering conditions of the global financial crisis, GFC, in 2008. An estimated total loss of $10.2 trillion in household wealth was directly attributable to the credit crisis, according to a Federal Reserve study. That's not just numbers, that's retirements postponed, homeownership dreams shattered, hard-earned wealth wiped out. Barr's work, particularly his emphasis on long-term stress testing underpinned by increased capital retention for banks, was meant to insulate us from just this kind of disastrous scenario. Of course, the Trump administration sees that as unnecessary red tape that hinders growth, but at what cost? But let's look toward the bigger storm gathering on the horizon. Barr's departure triggers concerns about banks being let off their regulatory leash. Sure, they may get to chase short-term profits, but this plays dangerously closely to a debt-fueled economic boom we've seen before. And history shows that growth can easily be curbed if bank balance sheets become over-leveraged, especially with rising geopolitical tensions and weakening global economic indicators. Consider how global debt crossed the ominous $307 trillion mark as of mid-2024, according to the Institute of International Finance. Global borrowing levels have ballooned after periods of low interest rates, and that debt isn't just a statistic, it's a direct insight into how vulnerable even the strongest economies have become to sudden shocks or market adjustments. More households, countries, and businesses than ever are juggling unsustainable debt loads, with the specter of recession looming across the globe. As the World Bank cautioned in 2024, there's a risk of recession for many advanced economies, stalled productivity growth, and weak policy coordination ambition. At precisely a time when economies need to build up their resilience, Trump's agenda appears to be lowering oversight and propping up banks to take greater risks, with parallels to the pre-2008 bubble-bursting event. You see, when Barr signals that the incoming Trump administration might target regulators and soften policies designed to make banking safe, you should see alarm bells ringing. The probability of systemic risk increases exponentially. Individuals and professionals linked to the financial world should have cause for concern. Unregulated, these large banks, not just in the US but worldwide, could transmit significant loss exposure globally as they're heavily intertwined through investment portfolios. So what should we really fear in the coming years? The erosion of capital and liquidity rules, fueled by political pressure, suggests the possibility of another systemic collapse, albeit through different triggers from 2008. Bank collapses don't always start with the structure of financial markets, they start with leadership crises and regulatory compromises. Even though Barr credited himself with developing a safer banking regime by enhancing stress tests and keeping an eye on capital reserves, his departure opens the door to regulators more inclined to echo Trump's favorite mantra of America First, deregulation, essentially letting powerful economic institutions run unchecked again. In closing, folks, Barr's departure isn't just a commentary on how financial governance fails when political interference escalates, it's also a signal of the looming risks we continue to ignore. Will capital markets stabilize long-term? Probably not. Will the system become more volatile thanks to loosened reins on superbanks? Almost a certainty. This issue isn't just wonkish chatter reserved for economic reporters, it affects your life. Financial fragility translates directly into job insecurity, housing instability, and retirements at risk. Barr's departure from policymaking will be a loss for stability seekers because he was working at cross purposes to protect Main Street families by tethering Wall Street's risk appetite. The broader economic implications mean bank regulation uncertainty is expected to seep into lending patterns, credit conditions, and, in an era of high-cost geopolitical risks, could set us up spectacularly for another crash. Keep your guard up, because these developments mark the early signposts of where the most debt-sensitive economies start faltering. That's today's breakdown of Barr's sudden resignation from oversight at the Federal. The plot is thickening, and as the tectonic plates of regulation shift under Trump's optics, it's Main Street, not the bankers, who will bear the brunt of financial mistakes. Thanks for tuning in, and as always, don't forget to like, share, and drop your comments below.